Hi, I'm Brooke Thackeray with Horizons ETFs. Thank you very much for joining me today. Today I'd like to use the Horizon Seasonal Rotation ETF, ticker symbol HAC. Its weekly commentary is the basis for this market update. So let's jump right in and take a look at the market action last week. Here we can see the S&P 500 was up 1.7%, which is a huge gain compared to the Canadian stock market, which was actually slightly negative last week. The big news last week for the U.S. stock market was the non-farm payroll, which came out on Friday. We did see 850,000 jobs created in the month of June, which was greater than expected. On the other hand, though, we did see the unemployment rate tick up from 5.8% in May to 5.9% in June. Overall, investors remained fairly bullish on the stock market, and the stock market closed higher on Friday. In fact, as of Friday, we have created 7 new all-time highs for the S&P 500 in a row. The last time this occurred was back in 1997. If we take a look at HAC, last week HAC did make some changes in the portfolio. It increased its S&P 500 position, and this was largely based upon the seasonal strength in the markets coming into the Q2 earnings season, particularly the first half of July on average. You tend to see the S&P 500 actually perform quite well until July the 18th. So HAC did position itself with increasing its S&P 500 position. If we take a look at what's happening in the stock market overall, let's start by taking a look at the interest rates. This is the yield on the 10-year Treasury note here. It closed at 1.44%, so it was lower again last week compared to the week before. We have seen this steady decline for the yield on the 10-year Treasury note since the end of March, and that's been driving some of the sectors in the stock market. In fact, if we take a look here with the major sectors in the stock market, well, here's the S&P 500 at 1.7%. Last week. But look at the discretionary sector, the communication services, and technology, and all three of these sectors tend to benefit from lower interest rates because they tend to be more growth-oriented. Look at the technology sector, really strong performance last week overall. If we take a look at the cyclical sectors, now they all actually underperformed the S&P 500. The energy sector in the U.S. was actually negative last week. Industrials, materials, and financials were all positive, but underperformed the S&P 500. Look at the defensive sectors here. If we take a look here with these 4 sectors, real estate, staples, utilities, fairly flat, positive but fairly flat. But look at healthcare. Healthcare had a really strong week, up over 2% last week. On average, over the long term, the healthcare sector has been one of the top performing sectors in the month of June. And last June, was the previous month that we just passed, was actually a strong month for the healthcare sector as well, once again. If we take a look at some of the subsectors in the marketplace, we saw the semiconductor sector do quite well. Now it's been doing quite well based upon shortages of semis. And also, too, as well, we've seen new plans starting to be planned to come on board. So there's a lot of positive excitement around the sector overall. Home builders benefited from falling interest rates. The banks actually underperformed, largely because of falling interest rates as well. If we take a look at gold here, gold was positive last week. Now, I want to point out gold because gold is just coming into its strong seasonal period, which lasts from July 12th to early October on average over the long term. And commodities tend to be quite volatile even in their seasonal period, and sometimes the numbers aren't as robust as what people would like, but they do tend to perform well in this period on average. And right now we have seen gold actually become a little bit attractive from a technical point of view. We did see gold actually correct based upon the FOMC meeting. And as the Federal Reserve started to talk a little bit about tapering down the road, and it was very nebulous, but nevertheless, the market did push gold lower on that. If we take a look here on RSI basis, relative strength index basis, the gold became oversold and starting to show a little bit of strength. And on the full stochastic oscillator basis, which is a price momentum indicator, it became oversold and also starting to show a little bit of strength. So we've seen the gold actually pull back just before the start of its strong seasonal period. So it's possible that we could actually see a little bit of a bounce. If we take a look at the markets overall, we've seen the markets actually doing quite well. I mean, particularly recently, the S&P 500 has done quite well coming into this earnings season. And on a seasonal basis, there tends to be still a tailwind for the stock markets into about mid-July. But investors should still be careful here because you have to be a little bit nimble as far as that goes, because coming up, August and September are the worst two contiguous months of the year on average over the long term for the S&P 500. And the last half of July tends to be the weaker half of July. So yes, we may see the market still actually do okay here coming into the earnings season until the earnings season starts, and it could still go up even after the earnings season starts as well. But we are starting to get into the period shortly where the market can actually start to perform a little bit weaker. Thank you very much for joining me today.